What we've seen in the banking crisis thus far has really been, large losses by institutions across the board. The last count, it's well over $350 billion in counting. And that's certainly been the biggest surprise to us. When we first heard about some of the interest-only loans and negative amortizing loans, thought that it was confined to a relatively small space in the market, but it's just the extent of the losses has certainly been a surprise to us. So now, with that size of loss, you have to ask yourself as an investor, what are the long-term implications? Certainly the press is filled with stories about what's going on right now and recent price moves, but for investors, what do we need to think about for investments over the next 5 years? First off is there's going to be less credit. In developed nations, they'll all work on a fractional reserve banking system. That means you don't actually have to have all your money in the bank, only a portion of it is there to secure your loan. And it works out to be roughly $9 of loans for every dollar of deposits. That means, in very simple calculations, that for $300 billion worth of losses, that represents $2.7 trillion worth of loans that won't be made. So that you know that there's going to be less credit available. And for any corporation that depends on the availability of credit to grow or to finance their operations, you have to be very cautious of that type of investment. Imagine if you've been in a car accident, how you're going to drive your car in the months right after the car accident. You're certainly going to drive it with a great deal of more care, and you're going to be looking for that next accident. So too are investors going to be looking at the next accident that could happen to them. So they're going to be very cautious of the investments they're going to take. They won't just believe anything that anybody says about investments. They're going to want detailed research, they're going to want proof. And that is a good backdrop toward long-term investing, but don't expect a flood of money to come in as it has in the past just because the sector is hot. If you look at when significant regulatory changes were enacted, they were always in response to something. So the Securities Exchange Commission was formed in 1934 as a response to the stock market crash. The Employee Retirement and Securities Act in the mid-1970s was enacted as a response to the market crash that we saw in 1973-74. And we're going to see the same type of regulatory move in the banking system. All the over-the-counter transactions, all the unlisted transactions that have been taking place are going to be subject to much more regulatory scrutiny. What are the opportunities for investors? And the opportunities are going to be investing in companies that A, don't need credit, so that they aren't vulnerable to a tightening credit market. The second thing is you're going to be looking for companies that are actually producing products and services, not just repackaging cash flows or financing their customers, that they are actually generating cash. So if you focus on those two key elements, those are going to be good drivers of your portfolio and will ultimately lead to much higher rates of return in the future.